Hi, I'm Richard Vague with Tychos. Last week, we noted that, as painful as the burgeoning trade war with China will continue to be, the contest with China is now on. But this isn't just about tariffs. It's about industrial and technological preeminence. But, as we analyze this trade war, it's very important to be aware of the factor that China is the most troubled and imperiled major country in the world. It's now squarely facing major crises and disruption from within. Its economic model, once seen as unstoppable, is showing deep cracks, and the measures to sustain growth are becoming increasingly unsustainable. Now, some of you might be thinking, we've been hearing this for 20 years, and nothing seems to have come of it. But in just the last 2 to 3 years, the warning signs have become impossible to ignore. GDP growth in China has plunged from 15% in 2007 to under 5% today, and probably not that high. Probably lower than that, and on a path to 0%. Major companies like Evergrande have collapsed, and civil unrest is accelerating. China's most fundamental, inescapable dilemma is that its population growth is not just slowing, it is actually declining, and imploding may be the better word. No birth rate increase, no government policy, and no immigration strategy can reverse this. And no country can long maintain power in the face of a sustained decline in population. Further, as was the case with Evergrande, the debt load carried by its corporation is twice that of U.S. corporations, while the collective cash earnings of those corporations has been an unsustainable negative 10% of GDP for years, which frankly is a little-known fact and little discussed fact. Despite its export strength, China is also dangerously dependent on imports, a lot of that for the imports necessary for the inputs in its manufacturing processes, and a huge part of that being energy, petroleum products specifically. It remains one of the most import-reliant major economies in the world. Without access to global shipping routes, particularly the Straits of Malacca, China's economy would grind to a halt probably within months. Those of you who are historians may recall that access to oil was one of the key issues in Japan in 1941, and our threat to shut off oil exports to Japan at that time led to a little thing called Pearl Harbor, which was part of a multiple front offensive conducted within a few days, including taking over the oil fields of Indonesia, specifically to address that limitation, what was in essence an oil crisis for Japan. But that's an aside. China may be able to stave off the worst of the consequences it faces for, a few years, 5 or even 10, but it can't reverse them. There's nothing out there big enough accessible enough to reverse them. If anything, its internal problems will make it more dangerous to the rest of the world, since the time-tested way for a country such as China to deal with an internal crisis is to concoct and vilify an external enemy, such as the United States. With its growth woes, it will need to continue to increase government spending to boost its economy in the face of declining areas in other parts of the economy. And one of the easiest places to increase central government spending in any economy is on the military. And you'd expect that to be true in China for a variety of reasons. But as its military gets larger and larger, it's all the more likely to lash out. China's economic struggles are clear, but for the U.S. to truly capitalize on this moment within the context of this trade contest. It will take much more than just tariffs. You can block incoming imports through tariffs, but what do you replace them with? What we really need is accompanying strategic industrial investment to rebuild America's manufacturing dominance. It won't happen easily, and it won't happen with significant investment. And that's an obvious place for the government to play a major role. The opportunity is there. The question is, will we seize it or let it slip away? We'll discuss that more in the weeks to come. That's it for this week, and as always, you can find the charts from this video in the email you receive, and hopefully it's of use to you. Thanks for tuning in.